with chaos at the New York Stock Exchange.
Get back in there at once and sell! Sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Financial Advisor at BIG Investment Services. That's BIG, Booth Investment Group. We're a full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, June 27th, 2025. Some shout outs to all the Eds. Ed, Eddie, and Ed. Saw them all this week. How about Mike, Kathy, Chip, so many others too. Look, I can't list everybody, but when folks come into the office quoting the podcast, I got to really try to give them a shout out if I can. So look, let's go ahead and jump into it. Let me start by saying this. Happy New Year. That's right. Happy New Year. Yeah, what do I mean by that? Yes, I know it's June. Yes, I know it's June 27th. What do I mean by Happy New Year? Okay, we are officially entering the period of time in the year where the market is going to start just kind of discounting 2025 and it's going to really start to look at 2026, right? So much for 2025. The market wants to know what 2026 is going to do. And you're going to start seeing the market really start to focus on next year and the potential earnings on the S&P 500 and react accordingly. So I think the market's starting to do that at this point in time. But as far as the here and now is concerned, look, it's a confusing week, right? I know a lot of folks were like worried about this week. I got some folks reaching out to me last weekend. Oh my goodness, what's going to happen? And I said, look, a couple of things. I said, if Iran, I think it hinges on Iran, if Iran has the willingness and the capability to respond in a real way, it could get ugly. I said, but if they don't, it will not take this market long to view a denuclearized Iran as a long-term net positive. When you talk about not taking long, it took up till Monday. I mean, the market opened up Monday morning, never looked back, was solid all week long. It was a little touch and go there for a moment. There was a ceasefire was announced and some things were launched. I mean, I couldn't believe it. The ceasefire was announced and Israel suddenly just unleashed, it looked like every piece of ammunition that they ever owned. I was watching the news and I was like, why in the world is the sky lit up that much? It looks like the worst night I've seen so far. Anyway, things got a little touchy there Monday night into Tuesday morning. And if any of you are watching the news, I was watching CNBC Live when President Trump made his comments. And let's just say they were very colorful, very strong comments about these two countries not knowing what they're doing. And then shortly thereafter, Israel turned the planes back around and things have been calm since. All said and done, the market's looking forward. You saw energy prices pull back. You saw the market strengthen. Things calm down. There's some talk that maybe some negotiations with Iran moving forward, et cetera, et cetera. So all good stuff there. And the market's responded in kind. So look, the Dow Jones was up 3.8% this week. The S&P up 3.4%. The NASDAQ up 4.2%. The Russell Small Caps up 2.9%. Big moves across all major indices this week. And then the volatility index, as you might expect, down big time, down almost 21% this week, down to 16, really low level there. Could go a little bit lower though. It broke through a key level of support, which would indicate that volatility could stay low for a while, could even drift a bit lower. Long-term bonds even getting in on the love this week. They were up 1%, so a little bit of positive action there. And then when you look at all of the different sectors, the bottom line is areas that were geared for growth were up a lot. Semiconductors up 6.9% for the week. Discretionary up 3.7%. Financials up 3.1%. Industrials up 3.1%. Tech up 4.2%. Other things like the defensive areas of the market, things like consumer staples down 0.5%. Utilities only up 0.5%. So not as much action there on the defensives. And energy was the big laggard this week, down 4%. Mainly because oil dropped off so much, right? Things settled down quickly in the Middle East. So did oil and energy stocks. They pulled back a bit this week. How about gold and silver? Gold down 2.8, silver down 0.3. we've talked a bit about this. I've mentioned that if the market is shown some love, it's probably going to hurt gold, and we're seeing that this week. So gold down a bit. I still think gold looks constructive. I think federal banks around the world are stocking supplies of gold, and I think it can push higher. So that's what's the indices, that's what the markets were doing this week. There's a couple other things going on. You have Fed Chair Powell, he testified to Congress this week, made no indication whatsoever that he has any inclination of lowering interest rates anytime soon. And again, he's taking a lot of heat for that. I think that he's focusing a little too much on tariff inflation. I mean, look, inflation's numbers have been coming down significantly. I will say that the PCE number, that's the one that the Fed pays the most attention to. It is still relatively sticky. Okay, the numbers came out this week. They're still a little on the sticky side. But overall, inflation's come down quite a bit. And I think the tariff inflation is going to be a one and done. Tariffs are going to hit. They're going to make their impact. And that's going to be it. It's going to be one and done. We'll probably won't see that impact until the third quarter. So I'm not even sure you're going to hear a whole heck of a lot about it in this next quarter's earnings announcements, which will be starting here in a few weeks. But I do think by the following quarter, you'll start to hear a little bit more about it. And you might hear it in the projections this coming earnings season as well. Speaking of earnings, FedEx reported. We don't have it in our models, but I watch it. Didn't really care a whole lot for the report. Stock's looking pretty attractive. If I had more cash, I'd buy it. So that's another issue. David, what are we doing? Well, I tell you what, we've been fully invested really since May 15th. We raised up a ton of cash on March 31st. And within 2 weeks, we put a big chunk of it right back to work again. The market got clobbered after tariff announcements. And that April 7th, 8th, and 9th, we bought a lot of stock. And then we just kind of were waiting for the market to rally and then retest the low, because that's normally how it goes. I've talked to most clients we've been meeting with about that, waiting for that retest. And by the middle of May, it just looked to me like the market didn't want to do it. It just didn't look like it was going to go down and retest those levels. Things just got too constructive too quickly. The market accomplished too many things that indicated that the worst was behind us. And therefore, we went ahead and loaded up and just kind of got fully invested on that day, added some more stock and some other investments and just kind of dwindled the cash down. We got a little bit more cash to work with. I mean, maybe 2%. So if something pops up here during earnings season, we get an opportunity to do some buying, I'll try to put that 2% to work. But if I want to buy something right now, I've got to sell something to do it because we've been kind of fully engaged here, taking advantage of this move. Now, for new clients or folks that have added new money, I've been working your money in over the last couple of weeks. So 2 weeks ago, I did a lot of buying. Last week, I did a lot of buying. This week, I did a little bit of buying, not too much, just wherever there was opportunities that things took a hit. You know, Shopify, for example, was down a couple of days ago. We picked some of that up. Kinross Gold, the gold mining company that we've got in the portfolio that's been on fire for quite some time now. It was down quite a bit today, still up 60% on the year, but it's down quite a bit today. So I'll put some money in there for you. And we'll be waiting for opportunities to rise. As certain stocks stumble, or if we get bad days in the market, we'll get your cash worked in there and get you fully invested as well. And look, for those of you that aren't clients, that are home gamers, if you're not in the market, you know, if you've missed out, if you pulled all your money out of fear that the world was falling apart and didn't get it put back in again, you missed it. However, if you get any sort of pullbacks, you take advantage of them. You know, I thought there was going to be a bigger pullback. Okay, we talked about this on the podcast. I really thought you're going to get your opportunity here over the last couple of weeks. All the technical indicators that I follow indicated the market was overextended, that it was definitely poised for a drop after this big move since April. And we were ready, looking forward for that to happen. Just didn't come together. You know, I mentioned a few weeks ago, look, this thing can digest one of two ways, either by going sideways for a long period of time or by having a significant pullback. We got a little bit of both. It's really gone sideways for a few weeks now. And we've had a couple of pullbacks along the way as the Israel-Iran thing hit the news and stuff like that, but nothing all that significant. So that's where we are at the moment. So we're in great shape. We're up significant double digits on the year. Actually, my attention is going to be turning now, moving towards the end of the year for the large account models. I'll be looking to trim stuff. I mean, we're up so big on a lot of these things. I'll be looking to do some trimming. You know, we've had some stuff that we've added to, new things that we bought, and especially things that we've added to. I mean, I added to AMD just a few weeks ago at $96 a share. You know, now it's up to $143. You know, it's up 39% this quarter, 29% month to date. You know, this thing's moving. And that's not the only stock. We've got a lot of stocks that are moving like that, up big time. And I will be looking for opportunities really to maybe trim back on some of that stuff as we move in towards the end of the year because, and I've been saying this to clients, actually one client bring up to me today, and I hope I didn't misstate myself last week. I was talking about recession last week. Let me make this really clear. I am not anticipating a recession anytime soon at this point in time. But let me say this, recession is going to remain a risk that's going to stay in front of us nonstop until we get one. The easy money has been made since the lows of 2022. And now recession risk is going to remain in front of us until it actually happens. And recessions do not warn you. They do not pre-announce their arrival. They sneak up on you. So from here forward, we are going to be very strict and disciplined at maintaining our diversification. We weren't that diversified coming out of 2022 because we bought a bunch of stocks, right? We loaded up on stocks in June and October of that year when the markets were getting clobbered. And we've been very, very U.S. stock heavy until this year. And we've really backed away from U.S. stocks. We spread money out overseas and added money to other areas. And we're going to maintain that discipline moving forward because I don't know when recession is going to happen. And I see some cracks here and there that are really early preliminary types of cracks you see in some of the economic data, but it still could be years away. It could be years away, which means if the market just goes screaming higher, we might make a little bit less, but I'd rather make a little less and be prepared for the unexpected than to be swinging for the fences and get stung. And that's where we sit at the moment. And look, the S&P is up 4.9%. And all of our moderate risk and our aggressive risk models, our large models, they're all up double digits. So I'm not sweating any of that. I think we're in great shape and we've handled all this quite well. Very happy with where we sit right now. I think moving into this next quarter, you'll start to hear some more talk about tariffs. That could shake things up a bit. But I'll say this next quarter has got a tailwind. There's something that's going to help support stocks on these next quarter's announcements, and that is the weaker dollar. Look, the S&P 500 derives about 41% of their revenues from overseas, 41% of revenue from overseas. And I think that is going to be a bit of a tailwind to help prop up earnings in this next quarter. And I also think that the market is starting to see things come together. Look, when Donald Trump was elected, the market got excited about certain possibilities. All of those things got very murky very quickly. And that water's now starting to clear and the market's starting to have better vision about what lies ahead. There's still some big ones in front of us. The bill has got to get passed. There's some hard no's right now on the bill. There's a lot of sausage yet to be made there. And listen, if that does not get passed, it's a 68% tax hike. It's the largest tax hike in United States history. And let me also go a step further to say, just take the politics and forget about the politics and set it aside, as I get so sick and tired of the politics, and just look at the numbers from the IRS. The overwhelming majority of the benefit from those 2017 tax cuts went to households making $100,000 a year or less. It is not an opinion. It is a fact. So if you think that's tax cuts for the rich, okay, then maybe you've got something to argue about there. But if you're in that category making under $100,000 a year, then I don't think you want to see those tax cuts go away. That said, there's a whole bunch of other stuff thrown in there, a lot of other garbage, et cetera. They got to work their way through it. And the market get knocked around by that, all right? It could get knocked around depending on those headlines moving forward. Tariffs are also something that's not resolved yet. The market just today here on Friday got hit in the back of the head for a moment because President Trump came out and said that all tariff negotiations with Canada are off immediately because Canada put on a tech tax and they're upset about it. And they said all negotiations are suspended and Canada received a letter in 7 days telling them what their new tariff is going to be. In addition to that, in the presser that he had today, he also talked about the fact there's no way that we can negotiate all the deals that we would have to negotiate by this deadline that we put in July. And he said these countries are going to get letters, right? He said, oh, we're working with India, Europe, China. Everyone else is going to get a letter and they'll be told what their new tariff's going to be. That is a big unknown that can certainly knock markets around a little bit. So again, going back to what I said earlier, if the opportunity arises, markets pull back, we want to kind of jump on it. We're already on it. We're already in it. If there's anything that really sticks out at us, we'll try to take advantage. But I don't think we're going to get really big opportunities from here to buy. I think the market's looking pretty resilient at the moment. Might get a step back here or there, but I don't think it'll be major. You might be lucky to get 2 or 3% drawdown. So that's pretty much what I've got for you this week. Next week's going to be a short week. It's July 4th, towards the end of the week there. So I'll be doing the podcast early on Thursday. Other than that, I think things are looking pretty constructive. The market's still expensive, folks. There's no doubt about that. But earnings are key. The market's going to start looking to 2026. If the market believes that things are coming together in such a way where earnings can accelerate, tariffs are done, the bill is done, et cetera, then we could start to see the market respond to the potential for some earnings growth, and we can see this thing push higher, even though today I was still considered to be rather expensive. So look, I'm going to go ahead and wrap up. But between now and next week meet, as you're thinking about your future, your long-term goals, all the things you want to do with you and your money, maybe it's take the entire extended family to an all expenses paid vacation to Disney. Maybe it's buy that second house, pay for that college education. Well, you know what your goals are. Don't just think about them. Think big. Think B-I-G. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.